Welcome to our 2023 Outlook. Looking back over the past couple of years, it's clear that pandemic policies and Russia's invasion into Ukraine marked turning points in economic stability and geopolitics. During this time, inflation in the United States steadily rose to the highest level in 40 years and is now rising globally, along with weaker foreign currencies, higher rates, and lower financial asset prices. The Federal Reserve, along with other major central banks around the world, have been hiking short-term rates, in some cases aggressively. At the same time, they're running into structural forces that are restraining the supply of labor and housing, while food and energy insecurity is rising globally. Today, we're going to talk about these and other forces affecting economic and financial market trends in 2023. Now, to start, Steve, we've had good discussions about deglobalization. Will you share with others what we mean by that and how that may affect the economy next year?
Sure, Brian. And this is going to be a trend that's going to take place over a longer period of time. It's not just the next 3 or 6 months. Globalization's been going on for the better part of 30 years. As companies were able to seek out lower cost labor to hold costs down, help hold inflation down across companies. But the onset of the global pandemic really highlighted the risks of all of our production being overseas. Our distribution got tied up as our supply chains got gnarled up. As we move forward, we think that companies need to rethink these risks of their business model, and it may lead them to reshore some jobs away from these lower cost areas to North America. That might have the impact of raising costs a little bit. It might keep inflation a little bit higher, but it's a way for them to manage those risks of the business model that really were not in place before. There's some geopolitics in play here as well, and what Russia's action in Ukraine hasn't helped that, but this is really about the global economy becoming a little less efficient as we move forward.
Matt, Russia's invasion into Ukraine, what does that mean for oil and gas markets, and what may it mean for the economy next year?
War continues to rage in Europe, and the fact is it's exposing Western energy insecurity. Russia is a top 3 producer of oil and natural gas and the largest exporter of natural gas in the world. In fact, they supply about 30% of the natural gas used in Europe. While the developed world spent the last decade investing in alternative energy, they now are being exposed to a shortage of fossil fuel, and it's creating a crisis. When Russia stopped delivering natural gas to Europe in the summer of 2022, we entered a crisis mode for energy, and that's spreading around the globe. Now, the solution to the challenges right now is obvious. It's LNG, or liquefied natural gas. And so what we're going to see, I believe, is that countries with ample natural gas resources and adequate chilling facilities are going to win in this economy. And those countries might be places like Qatar, Australia, and the United States. Yes, the United States has a huge natural gas reserve, and they're going to benefit from this. Now, as to its impact on markets, I would point you to 2 things. First, companies are experiencing higher costs, and those higher costs are likely to be in place for some time as it relates to energy. And second, countries with access to low-cost energy are likely to have a competitive advantage in the global economy.
Energy and geopolitics will likely have an outsized impact on economies and markets for years to come. In light of these changes, here's our view on U.S. economic growth and inflation for next year. While the U.S. economy was pretty resilient last year, we're expecting the economy in 2023 to slow, and the probability for recession has certainly risen. Why? Because the Fed isn't done yet, and we haven't yet felt the full effects from previous rate hikes. Now, with the slower growth, we are expecting the unemployment rate to rise. However, the job market may not be hit as hard as in previous slowdowns because job openings still exceed the available pool of labor by nearly 2 to 1. Now, fortunately, inflation will trend lower, primarily due to lower goods prices, but service inflation will remain stickier next year. Now, Steve, what is our view on fiscal and monetary policy for 2023?
Yes, Brian. Well, look, for fiscal policy, let's just say the handcuffs are on. As we came through the pandemic, the federal government was able to spend a lot of money, borrow a lot of money, and really it didn't have a budgetary impact because interest rates were near zero. Now, as the Fed has started to have to try and fight inflation, interest rates are higher, the bar for fiscal policy from this point forward is just going to be a lot higher. And that puts a lot of pressure on the Fed. As they think about how inflation is going to unfold from here, as you mentioned, the labor market's going to play a huge part on that. But at this point in time, if we listen to what the Fed's saying, they're thinking that rates need to be a little bit higher for a little bit longer as they work to slow the economy, see the labor market cool off a little bit, having that lead to lower inflation. Rates are at about 4% right now. We think the Fed gets them to about 5%. The good news is headline inflation has already started to slow on a year-over-year basis, but the numbers are way higher than what their 2% target is, and they've still just got some work to do. So look for the Fed to remain vigilant against inflation as we move through 2023, but we think inflation's moving the right direction.
Now, Matt, what about the outlook for stock and bond markets next year?
2022 was a difficult year for equity and fixed income investors, and international investors faced a strengthening dollar the entire year. So it was a rough year. As we look at 2023, I would tell you that the bond market appears to be pricing in much of our outlook right now, and I see opportunities in investment-grade bonds. When I look at equities, multiples have come down. Equities are cheaper, but the biggest risk among equities is valuation of earnings and how high those earnings stay. We think earnings are susceptible to revisions lower because of inflation, because of wage pressure, energy pressure, inventory excesses, and deglobalization. So as a result, equities could be in for a difficult start to the year. Now, with higher rates and slower growth, we're focused on value stocks as they're shorter duration assets in the equity market. When we look at growth stocks, we're looking for opportunities in 2023, but we'll be very growth valuation centric when we look at those opportunities. Now, this is a great environment for active management. Higher interest rates, slower growth, more impetus on companies to make a profit, that favors active management. So with that, I'm sure investors who are watching this are wondering, what should we do with our portfolios?
Over the course of the year, we are going to continue to manage both the upside and downside market risk within diversified portfolios as we've always done. For investors, it's our opinion that it's likely too early to increase risk significantly in the U.S. equity market at a time when multiples are still high and earnings are going to be under pressure next year with the slower economic growth. And the Fed isn't done yet. It's also likely too late to be bearish on international equities. Yes, the economic backdrop overseas is more difficult, but international equities are trading at some of the cheapest valuations we've seen in decades. The lingering inflation, the higher volatility, these are conditions that have historically been very good environments for hedge funds and real assets, including energy. Finally, given the big reset higher in rates, investors today don't need to reach out too far on the risk spectrum. Investors can also finally earn some yield on their cash, and that yield is going higher while they wait for better valuations in stocks. For 2023, we will be facing some new economic challenges as well as new market opportunities that we haven't seen in a long time. It's a good time for you to meet with your advisor, review your investment plan to determine any changes you may need to make within your investment portfolio. Thank you for listening and for your continued confidence in BOK Financial.